Let us help you reach your peak in retirement. It's time for Retirement Elevated with Sean Lee.
Hey everybody, welcome into this edition of the podcast. You're listening to Retirement Elevated with Sean Lee and myself as we're talking investing, finance, and retirement. And this week, it's tax consequences. We are into late January in the first quarter of 2021, and people start thinking about taxes, tax prep, getting ready for April, all that jazz. But of course, if you're working with Sean or if you've listened to our show before, you know that tax planning is really a bit more important. That's something that we're trying to do all year long, not just that that thing we do every April when we wait to the last minute and scramble around to pay the government. So we're going to talk tax consequences on some different things today. What's going on, my friend? How are you?
Living the dream. Just
rock star. Living the dream, baby.
Living the dream here in Salt Lake City.
There you go. I like that. You guys, how's the kids doing? They in the throes of winter, bumming that they can't do anything with baseball?
No, we're rolling.
Oh, that's right. You've got that facility you guys get to practice in.
Yeah, a good buddy of mine. We're very fortunate that as he's building a new building for his company, he built a massive warehouse in the back that's got, they put a gym in it for his employees and things like that. He really does a great job with his employees, and he was gracious enough to put some turf in for us, some cages. And so we've been practicing 2 days a week since December.
That's cool.
And I mean, the kids can't do basketball this year. They haven't.
Right. Gives them an outlet. Yeah.
Yeah. So they're doing that. And then my son he's full in throes of playing comp soccer right now.
Okay.
So,
all right. Very cool.
Activities are rolling for us, and it's been
different,
good,
man,
with masks.
Yeah. Kids, they just got to have outlets, man. So
they need to be around their buddies. And my heart breaks for my daughter because this was her first year of cheer. She was really amped up. She loved it. Well, they only got to cheer in, I think, 2 football games. They can't be at the basketball games. They can't. So really all they can do is practice.
Yeah.
And they're going to do a virtual competition or something.
Okay. So they get some camaraderie a little bit, but yeah. And I'm almost 50 here, and it's like I look at this stuff that's happening, and we want to keep our kids safe, but at the same time, like you said, your heart kind of breaks because you're like, this is I remember how much I loved my childhood and elementary school, and even though we all struggle sometimes in high school, I liked high school for the most part, Yeah. So it's interesting that, and it's kind of sad that they have to go through some of this stuff, but I guess that's the modern world right now.
If hopefully it's short term, right?
Short, exactly. Hopefully we're into the short rows now, and each day in 2021 will get a little bit better. That's the hope anyway.
Right.
Well, let's talk tax consequences, as I mentioned. So different types of accounts, Sean, have different kinds of tax consequences, and as we get closer to April, people start to bring some of these things up. So let's talk about some advantages, disadvantages, and different types of accounts, how you use them, don't use them, so on and so forth. So first of all, tell us what tax-deferred accounts are. Sometimes people get a little confused when we hear that kind of lingo. It seems pretty obvious, but some people do get a little confused. So what is a tax-deferred account?
So think about, those are your 401ks, your IRAs, your 403bs, TSPs,
right?
Anything that's a qualified retirement account through, as in the eyes of the IRS. And what happens with a tax-deferred account? If you think about it, you get a tax deduction right up front, which a lot of people like. As you're working, the idea is, well, great, I get to save some taxes. I get to put money away, and it's not seen as taxable income. And then it grows tax deferred, so you don't pay taxes on any of the growth as it's growing. But then when you start to pull money out at the proper ages, and which I'll go in a second, you are taxed at your ordinary income. And so think about the idea, if you're a farmer, you're taxing the harvest of your money. And when you're putting money away, there's some specific rules that the government says, and it says, hey, you can't touch any of this money till you're 59 and a half.
Right.
If you do beforehand, you have a 10% penalty. But we also, at age 72 now, we want you to pull some money out. We're going to require you to pull some money out. Now, there are some benefits to tax-deferred accounts. You get the tax deduction up front. The one thing you have to remember, and there's a common misconception out there that, oh, don't worry, you'll be in a lower tax bracket down the road.
Right.
But nobody can
you can't guarantee
40.
it, right?
Yeah. you could guarantee me at my age 60 that I will be in a lower tax bracket based on where future tax law is going to be, then I would know that that's a good decision. But the thing that I can't control what the government's going to do. I know where taxes are going to be over the next 5 years. And there's a lot of arguments about, oh, well, it's going to change.
Yeah.
But I have an idea of what that current tax law looks like. I have no control over what happens from 2026 and beyond, and I have no clue. So
yeah, and a lot of times so when you're thinking about tax deferred accounts, folks, it's basically the government's waiting on their money. They're fine for you to cut them their share later on. And so it's when you take the money out that you're going to have to pay them. And that's where people sometimes tend to forget. Because if you think about, you could have had that money sitting there 30, 40 years, Sean, and you've kind of forgotten along the way that you're watching it grow, and it's really cool, and it's neat to see it grow. And you go, wow, let's just use an easy number. We'll say, I got $1 million. And it's like, no, you've got less because you got a partner waiting on, possibly up to, 30% or so. You're talking, you might have $700,000.
Yeah, after tax.
After tax, right.
And that's where a lot of tax planning needs to come in place, because I see, and this isn't anybody's fault, it's the marketing machines have done a great job of saying tax deferred, pre-tax money. And so the majority of America, a big chunk of America, has money in tax deferred accounts because that's what they've been told to do.
Well, Sean, shouldn't we also, to a degree, these are very useful tools. I don't want to get people to have us wrong here, because especially if you're getting employee match. Hey, take the free money, right? You should definitely, should people be using 401ks and IRAs and stuff, especially when it comes to the matching, but also then look at some other alternatives for tax, planning purposes?
Absolutely. I would be a fool to tell you to not get 100% of the match that you could.
Exactly.
So,
other people's money is fantastic.
I'll take money. I'll take free money.
Yeah.
And when you look at the free money from your employer, what do you have to put in? So sometimes you've got to put in, maybe I've got to put in 3% to get 3%,
3, 5,
or 6% to get 3. Well, if I've got to put in 6 to get the maximum that they'll give me at 3, I'm putting in 6% because I want 3%, that extra 3% from the company, because that's a 50% return on my money day one.
Yeah, exactly.
And so there are a lot of benefits there that what we get caught up in is I'm going to shove everything into that bucket, that tax deferred bucket, and not worry about taxes until down the road.
Yeah. And then, so another option might be to look at the tax consequences, the advantages or disadvantages of going with a tax-free account. And typically on this avenue, Sean, we tend to think of the IRA's cousin, the Roth IRA.
Yeah. The Roth is, we talk about the IRA and the tax-deferred accounts, you tax the harvest. Well, with the Roth IRA, the seed of your money is taxed. So I pay taxes before I put the money in.
I like that idea to me, because I like to feel just get the pinch over with, right? It's like getting a shot, just go ahead and do it now, because you're going to forget about it, right? Take the money now and just roll on. And then there's that extra benefit to your point earlier, is that right now we know what that tax rate is.
Yeah, I'm done. I know. We're at pretty low tax rates right now as well. So,
yeah,
I'm done. I pay the taxes. The money grows tax deferred, and under current law, it comes out tax free.
Yep.
Right.
So that $1 million, to my point earlier, might actually be $1 million, 35 years from now or whatever.
Exactly. And there are companies now that are coming out with our firm, as an example, we have a tax deferred option and we have a tax free option in our 401k. So a lot of companies are providing this Roth 401k option where after tax money can go into it. Now, in most cases, a company match will still go tax deferred because there's a benefit to the company to do that. But fine. It's free money anyways. And so putting money into that Roth 401k option in a lot of cases, especially if you're younger, could make a lot of sense potentially.
Yeah, definitely so. Okay, so that's a couple of the main ones there. And again, there's consequences. There's advantages and disadvantages to both. Now, we talked about the tax deferred, tax free. Sometimes people get a little confused with the after tax or taxable accounts. What is that?
So the after tax accounts are just say, hey, I got paid in my paycheck. I paid all my taxes. I've got money sitting in my savings account. So I'm going to go out and take some money out of my savings account. I'm going to buy some mutual funds or some stocks or whatever it may be with after-tax dollars. Now, depending on what type of investment you buy, whether it's funds or individual stocks or ETFs, that will determine kind of the tax liability that you have based on the types of investments you purchase.
Okay.
But they're just investments that are purchased with after-tax dollars that I could, I have a stock account that's after tax. I could sell those stocks tomorrow and I could get the cash back, even though I'm under retirement age. So it's completely liquid. You just have to be willing to, take the risk of, do I sell at a high point or low point, whatever
Gotcha.
it may be, and you can get your cash back.
Okay. You mentioned the bank. You mentioned that. So like CDs, tax consequences there. I can't imagine there's much because there's just not much going on with, bank accounts. But anything for us to know there?
Well, with CDs, it's dependent on the wrapper that you put around a CD.
It's basically like income, right?
Yeah. So a CD is just a tool. So it's just a vehicle to put money in. So I could actually have an after-tax CD, I could have a Roth CD, or I can have an IRA CD.
Oh, okay.
I can have a CD under each umbrella. And so depending on what umbrella I put it on, if it's tax deferred, it's, I pay taxes when it comes out. If it's taxable, the way that a CD works, so if it's after-tax money, I pay taxes on the year that interest is accrued. So if I earn, $2,000 of interest in my after-tax CD, I pay ordinary income taxes on that money in the year that I accrue it.
Gotcha. Okay. Life insurance, is there anything there from a tax consequence standpoint? I know sometimes life insurance can get a little confusing as well.
Life insurance, the death benefit is tax-free.
Okay.
In most cases, not all. There's some qualified plans, things like that. But in most cases, life insurance death benefit comes out to the beneficiary completely tax-free. They don't have to worry about taxes on that big, $500, $600, $800 million death benefit. If there's cash inside of the life insurance policy where they have cash value, that in a lot of cases will come out what's called tax preferred, which it can either come out in the form of a loan or withdrawal of your basis where you don't pay taxes on that money.
Right.
You just got to be really careful. If you're pulling cash out from a life insurance policy, it's got to be structured properly. Far too often I see life insurance policies that, the idea is huge cash value down the road. It's not structured properly. It blows up in the client's face. And then they've got a tax liability at the end. So the life insurance policies do have to be structured properly.
Okay. All right. Well, there you go, folks. So there's some tax consequences for some different vehicles, for some different financial products. And again, as with anything, if you've got questions or concerns, always check with a qualified professional before you take any action. But if you're thinking about how you want to plan for the future, tax planning is really a crucial component of a good retirement plan, and that's what Sean and his team do every day is they build retirement plans for folks. So if you need some help, got some questions, 855-50-RETIRE is the number to call. 855-50-RETIRE. Get on the calendar, have a conversation. Subscribe to our podcast if you'd like to do so. We'd certainly appreciate it. You can find all the information, blog posts, all that good kind of stuff at retirementelevatedpodcast.com. That is retirementelevatedpodcast.com. Maybe you got this through an email blast or something along those lines from Sean's team. So if that's the case and you haven't subscribed, consider doing so on Apple, Google, Spotify, iHeart, Stitcher, so on and so forth. And again, you can find it all at retirementelevatedpodcast.com. And I'll leave us with a little fun fact here, a little history fact here for the month of January. Sean, you want to feel oldish, I guess. 14 years ago in January, the first iPhone was put out. So 14 years already.
I had that iPhone. It was like completely metal. It was heavy as could be. and my wife and I were talking, I don't know if you remember, so when we were in college, this was 2000, 2001.
Right.
The Razr phone, Motorola Razr was all the
rave.
rave.
Oh, man, that was a great phone, though. It was really good.
I loved it.
I had a Nokia. I'm a few years older than you, so I had one of those skinny, long, pull the antenna out Nokias. My dad had a bag phone in his car back in the 80s. So so all that good stuff. But I don't know why it hit me as funny, but it did with the iPhone because it's like time goes so quick sometimes. I'm like, oh, the smartphones have probably been around. The slick smartphones. I don't know. We've probably been on those 10 years. And it's like, no, we've been on those almost 15 at this point. So it's like, oh man, time goes by too fast.
The iPhone is 3 years older than my daughter.
Oh, there you go. There you go. All right. Well, that's our history little moment for the show, as well as our podcast. Thanks, folks, for your time. As always, have a great week. Stay safe and sane. Sean, my friend, I'll talk to you in a couple of weeks, and we'll do it all again.
All right, brother. Thank you.
We'll see you next time right here on Retirement Elevated with Sean Lee.
Investment advisory services offered through Elevated Capital Advisors, LLC, an SEC registered investment advisor.